Well, it was another record-setting day for gold. Early this morning, before North American equity markets opened, gold was trading at $3,509 per ounce. It is up about 30% so far this year. For more, we're joined by Bloomberg senior commodity strategist Mike McGlone. He joins us from Miami. Mike, thanks a lot for joining us. I'm looking at my Bloomberg terminal, and the headline on the video segment that I see queued up on my screen says, "We are in a very scary area for gold, Mike McGlone." So you're the author of that comment. Why do you think this is a scary level for gold?
Well, Andrew, I enjoyed going back and looking at the last 100 years of gold annual returns. This year, this morning, ranked number 7. The top 5 were all in the 70s in the midst of the Arab oil embargoes and the Nixon debasing the currency. Number 6 was 1934, a year after FDR debased the currency, and then we have this year. So the whole situation is very disconcerting. Almost every time gold goes up a third on a year, you have pretty serious discombobulation in global economies. You have U.S. recessions. And it's a sign, I think, what's different this year, it's really unique, is every single time we've rallied like this, inflation increased, crude oil increased, and the stock market was generally dicey. This time, the stock market and crude oil both down. So what I'm seeing is deflation from the inflation. It's all the lessons of history tell us. When you get the massive inflation pump we had to the peak in 2022, you actually always revert to deflation. Now, it's taken a little while. Looks like we're really starting that reciprocal trajectory downward and towards deflation.
Do you see the rally continuing in gold?
Yes, trend versus trade. Short term, it's very stretched. The market's very extended, certainly versus the S&P 500. It could get back to $3,000 an ounce, a normal backup in a bull market, but it is a bull market. I think it's a matter of time it gets to $4,000 now. And significance is Bloomberg intelligence points out is if we do get a recession, which is becoming the base case, in the U.S., that the S&P 500 will go to 4,000 as fair value, which means S&P 500 gold might meet at that level per ounce price of gold, which would be 1-to-1, which is basically about the historic mean.
Tell us more about that. That sounds random, the points number on the S&P 500 stock index and the dollar price of gold. Why would you draw something from that?
Well, I draw, first of all, from Bloomberg Intelligence, pointing out 4,000, the S&P 500 is about fair value in recession. We're tilting that way. I think it's almost a certainty, particularly in the back of most analysts expecting it 2 years ago. We didn't get it. Now what are we getting? The delayed reaction with very good reason. As we all know what's happening with tariffs and austerity in this country. So it's just tweaking that. Remember, before at the beginning of the year, the stock market cap to GDP in this country was 2 times. There's only been 2 times in history of relevance, 1929 U.S., 1989 Japan. So we're all heading that way. And the significance is gold typically has a tendency to run to primary round numbers. So it bumped up against 2,000 forever and held. It got to 3,000 this year. It's holding for a little while. And now it's probably on its way to 4,000. It usually likes those round numbers.
There's a view out there that capital is fleeing U.S. assets because of U.S. Tariff policies, which are seen as a self-inflicted injury to the U.S. economy. Is that a key driver of gold? And secondarily, or even primarily perhaps, is that why the U.S. dollar has collapsed? And do you expect further weakness in the greenback to benefit gold?
Well, two key things there. I think it's a certainty. Rational portfolio management says you're supposed to be selling some U.S. Treasury securities. They're just way too expensive. At the end of the year, stock market cap to GDP in this country was the highest in 100 years, and the U.S. stock market cap to the rest of the world was the highest in about database going back almost 100 years. So that's very expensive. The prudent thing is to sell, certainly with a trigger. The key thing is bond yields have been going up, and that I think is leading to the alternative has been gold. But I think the bottom line here is prudent investors get it. The U.S. exceptionalism has been shifted, but also remember the key thing about the dollar and U.S. stock market versus the rest of the world have been in almost the exact same chart since the bottom in 2009, and they're breaking down together. So U.S. stock market and dollar have essentially been the same thing. The bottom line is when you get to 2 times GDP and market capitalization, the stock market becomes the economy.
Mike McGlone, senior commodity strategist at Bloomberg Intelligence. Thank you, as always, Mike, for your insight.